What if I told you there's a playbook written almost 100 years ago that could give you the confidence to navigate today's absolutely chaotic market? I mean, with AI disrupting everything and the economy shifting under our feet, that sounds pretty good, right? Well, that's exactly what we're diving into today. We're going to decode the timeless strategy of value investing straight from the source, Benjamin Graham's masterpiece. In the next few minutes, you are going to learn how to tame the irrational Mr. Market, see how Warren Buffett took these ideas to a whole new level, and most importantly, unpack the 2 essential tools you need to start thinking like a true, intelligent investor.
So first, you have to understand exactly who or what you're up against. Graham asks you to imagine the entire stock market is a single person. He's your business partner, and his name is Mr. Market. And let me tell you, this guy is moody. One day, he's totally euphoric, offering you insane prices for your shares. The next, he's in a full-blown panic, practically begging you to take his shares for pennies on the dollar. The point is, he's emotional, he's irrational, and you can't rely on him for a single thing. So how do you win against a partner this erratic? Well, here's the secret. You don't. You don't try to guess his moods. You definitely don't try to outsmart him. No. Instead, you build a framework of discipline so solid that his wild mood swings just don't matter to you. You insulate yourself from his silliness by focusing only on what is real and what is rational. And that all starts with one fundamental distinction. Graham's first move is to draw a hard line right in the sand. You are either an investor or you're a speculator. There's really no in between. See, an investor does the homework. They do a thorough analysis, and they look at a stock as a piece of a real business that they actually want to own. The goal is safety and a decent return. A speculator, they're just gambling. They're betting on price movements, trying to guess which way the crowd is going to run next. And the intelligent investor's playbook, well, it's firmly and only in that first camp.
And this right here, this gets to the absolute core of the whole mindset. Your biggest opponent isn't Mr. Market. It's not some Wall Street genius. It's you. It's the person in the mirror. The real battle is mastering your own emotions, your greed, your fear, your impulse to just follow the herd. The true superpower here is discipline. It's not about being the smartest person in the room. It's about controlling your own behavior.
Okay, so where did this powerful philosophy even come from? Well, it was born from the mind of one man and then famously evolved by his most brilliant student. These are the 2 titans who shaped value investing as we know it today.
And it all starts with this guy, Benjamin Graham. He was a professor at Columbia, and he is known everywhere as the father of value investing. His books are basically the Bibles of the field. I mean, after living through the massive crash of 1929, he literally wrote the book, the original playbook on how to systematically find stocks that are selling for way less than they're actually worth. And this is where the philosophy gets really interesting. Graham's original approach was a pure numbers game. He famously searched for what he called cigar butt stocks, mediocre companies that were so cheap they had one last puff of value left in them. He'd screen for stuff like an extremely low price-to-earnings ratio. But his most famous student, a guy you might have heard of named Warren Buffett, he took that foundation and he evolved it. He realized that the quality of the business was just as important. He started focusing on things you can't always quantify, like a powerful brand or a competitive moat. And this quote from Buffett just perfectly captures that shift. He moved the goalposts. It wasn't just about finding a bargain on any old company anymore. It became about finding a reasonable price for a truly great company. And that subtle but profound change in thinking has guided Berkshire Hathaway for decades. Okay, so that's the philosophy and a little bit of the history. But how do you actually, do it? What are the practical tools you need to start applying this strategy? This next part, this is the real core of the playbook. The first and honestly, the most important concept you have to grasp is intrinsic value. This is your own private calculation of what a business is actually worth. Forget the stock price for a second. What's the real value of the whole company based on its assets, its cash flow, its earning power? This number, which you come up with through your own analysis, becomes your true north. It's your anchor in the storm. All right, once you have your estimate of that intrinsic value, you need the second tool, the margin of safety. This is Graham's golden rule, his big idea. You never pay full price. The margin of safety is simply the discount you demand between what you think the company is worth and the price you're actually willing to pay.
Think of it as your cushion, your buffer against bad luck or, let's be honest, an error in your own judgment.
Here's a super simple way to think about it. Imagine you're at a flea market. You're hunting for bargains. You do your research and you know that that designer shirt is genuinely worth $200. But Mr. Market, the seller, is having a bad day and he's slapped a $100 price tag on it. That 50% discount, that is your protection. And that is where your future returns are going to come from. So how did Graham himself hunt for these bargains? Well, he basically built a screening machine with a bunch of strict, non-negotiable filters. He wanted rock-bottom valuations, like a PE ratio below 9, to make sure he was buying cheap. And then he demanded a long history of stability. We're talking 20 years of uninterrupted dividends to make sure the business wasn't just cheap, but that it was also durable. It was his totally unemotional, systematic way of always finding that margin of safety.
So, we've covered the mindset and we've covered the toolkit. Now for the final critical piece of the puzzle, understanding yourself. Because Graham argued that your approach has to match your personality, and crucially, the amount of work you're actually willing to put in. Graham basically laid out two paths. First, there's the defensive investor. This person prioritizes safety and simplicity. Their main goal is just freedom from costly mistakes and a lot of effort. So they'll build a diversified portfolio of top-tier companies or index funds and pretty much leave it alone. Then you have the enterprising investor. This person is willing to dedicate serious time and energy to doing deep research, hunting for those less obvious opportunities, all in the hopes of earning a much greater return.
And this reveals a really powerful truth about the market that most people miss. Higher returns don't always have to come from taking on higher risk. They can come from putting in higher effort. The enterprising investor's edge isn't luck. It's the quality and the quantity of their research. It's the work they're willing to do. So, there you have it. The playbook is in your hands. You have the mindset to ignore Mr. Market. You have the tools to find real value. The only question left is the big one. Which type of investor are you going to be? Are you the defensive investor looking for stability and peace of mind? Or are you the enterprising investor ready to chase down those opportunities? Your answer? Well, that's going to define your entire journey.